$10.6 trillion. That is the estimated cost to the global economy if China disrupts Taiwan, not over a decade, in the first year alone. That number comes from Bloomberg Economics, and it represents 9.6% of global GDP, making it larger than both the COVID pandemic and the 2008 financial crisis combined. The reason is simple. Taiwan produces 92% of the world's most advanced semiconductors. One island, 92%. And most of that comes from a single company. I'm Alex.
And I'm Maya. Welcome back to Asia Tech Macro. Okay, Alex, I know we've covered semiconductors from many angles on this show, but I think today's topic is fundamentally different. We're not talking about who makes the best chip. We're talking about what happens if the factory that makes almost all of them suddenly goes dark.
Exactly. And the timing of this conversation is critical. On December 29th and 30th, 2025, the PLA conducted what military analysts called a blockade exercise around Taiwan. Multiple Western governments issued statements of concern. And then something interesting happened. In early 2026, PLA air defense identification zone incursions actually dropped to their lowest levels since May 2024. Only 147 sorties in February 2026. There was even a remarkable 7-day period from February 27th to March 5th with 0 PLA aircraft detected.
Wait, so tensions went up dramatically with the blockade exercise, then suddenly went quiet? That is an unusual pattern.
It is, and it is exactly the kind of ambiguity that makes this situation so dangerous for investors and supply chain planners. You can't tell if this is de-escalation or the calm before something bigger, and that uncertainty itself is a massive economic force. Companies are making $100 billion decisions right now based on their assessment of Taiwan risk.
And the biggest of those decisions is TSMC's own. Let me lay out the numbers because they are extraordinary. TSMC just reported Q4 2025 revenue of 1 trillion new Taiwan dollars, about $33.7 billion US dollars. Net income was $16 billion for the quarter alone. Gross margin hit 62.3%, and they guided 2026 revenue growth at close to 30% in dollar terms.
Those are historically incredible numbers, but here is what really caught my attention. TSMC's 2026 capital expenditure guidance is $52 to $56 billion. Let me put that in perspective. That is more than the entire GDP of about 120 countries. TSMC is spending more on factories in a single year than most nations produce in economic output. And 70 to 80% of that capex is going to advanced processes, which means the most cutting-edge AI chips.
And the AI demand is just insane. High-performance computing accounted for 55% of TSMC's Q4 revenue. Management raised their AI accelerator growth outlook to a mid to high 50% compound annual growth rate from 2024 to 2029. 50% annual growth for 5 years. That is the kind of demand that justifies spending $56 billion a year on factories.
But here is the existential question. All of that incredible business, all of that irreplaceable technology sits primarily on a 275-mile-long island that China considers a breakaway province. TSMC's most advanced production, the 2-nanometer node that just entered volume production, is exclusively in Taiwan. The Arizona fabs are running 4-nanometer. Japan is at 7-nanometer, upgrading to maybe 3. But the bleeding edge, the chips that power every NVIDIA AI training cluster, every Apple flagship phone, every advanced military system, those are made in Hsinchu and Tainan.
And that concentration risk is what everyone calls the silicon shield. The theory is that Taiwan's dominance in semiconductor manufacturing acts as a deterrent against Chinese aggression, because Beijing would not want to destroy the very fabs it needs. But is that theory still holding up?
That is the trillion-dollar question, and increasingly analysts are saying the shield is cracking. An MIT Technology Review piece from August 2025 was titled "Taiwan's Silicon Shield Could Be Weakening," and in February 2026, Catagalan Media published an analysis called "Rethinking Taiwan's Silicon Shield in an Era of Managed Diffusion." The argument is that as TSMC builds more capacity outside Taiwan, the deterrence value of the silicon shield decreases. If you can get advanced chips from Arizona, why would China's threat to Taiwan's fabs be as strategically paralyzing?
And there was a significant development in January 2026. CNBC reported on a U.S.-Taiwan chip deal that directly addressed the silicon shield question. The deal essentially formalized a framework where Taiwan would accelerate TSMC's U.S. buildout in exchange for enhanced security cooperation. It was framed as a win-win, but many in Taipei saw it as Washington extracting Taiwan's crown jewel technology under the guise of partnership.
Right. And that brings us to the central paradox of this entire situation. TSMC is simultaneously the most important company in the world, the most geopolitically vulnerable, and the most actively dismantling its own strategic moat. No other company in history has faced that triple bind, and every decision TSMC makes ripples through global markets, military planning, and the future of artificial intelligence.
Okay, so let's dig into TSMC's actual diversification strategy, because the scale of what they are doing is unprecedented. TSMC has committed $165 billion to build fabs in Arizona. That is not a typo. $165 billion. They are building up to 12 fabs in Phoenix, Arizona.
And the timeline is accelerating. The second Arizona fab, which was originally supposed to come online in 2028, has been pulled forward. TSMC plans to start moving chip-making equipment into that plant around summer 2026, with 3-nanometer production starting in 2027. They are also building 2 advanced packaging facilities in the U.S., AP1 and AP2, with construction beginning in early 2026. AP1 is expected to start mass production by 2028, focusing on SoIC and chip-on-wafer technologies, which are the packaging methods that make NVIDIA's AI chips possible.
So TSMC is basically replicating a significant portion of its manufacturing ecosystem in Arizona. But there is a catch, right?
A very important catch. Taiwan has what is known as the N-2 rule. Taiwanese authorities have restricted TSMC's overseas fabs from operating technologies less than 2 generations behind what is deployed domestically. So when TSMC is running 2-nanometer in Taiwan, the best Arizona can do is 4-nanometer. By the time Arizona gets 3-nanometer running in 2027, Taiwan will likely be in volume production on the next generation.
That is incredibly strategic. Taiwan is essentially saying, sure, you can have factories around the world, but we will always be 2 steps ahead. They are diluting the silicon shield just enough to satisfy American pressure, but retaining enough technological primacy that Taiwan remains indispensable.
Exactly. And here's what makes this even more complex. The yields in Arizona are reportedly lagging Taiwan by 12 to 18 months. Building a fab is one thing. Running it at TSMC-level efficiency is entirely another. TSMC has decades of process optimization knowledge embedded in its Taiwanese engineering teams. You can't just transplant that overnight.
And then there is Japan. TSMC's Kumamoto operation is upgrading from its original plan. They are now considering 3-nanometer at the second Kumamoto fab, which would make it the most advanced TSMC facility outside Taiwan. NVIDIA is reportedly a key customer driver for the Japan expansion, wanting geographically diversified production of its AI accelerators.
The Japan play is interesting because it serves dual purposes. It gives TSMC geographic diversification while also serving Japan's own semiconductor renaissance strategy, which we covered in a previous episode. Japan is providing massive subsidies precisely because it wants TSMC capacity on Japanese soil as insurance against Taiwan risk.
Let's talk about the ripple effects of this diversification on the broader industry, because TSMC's moves are not happening in isolation. Every major tech company is rethinking its supply chain.
The numbers tell the story. Apple, NVIDIA, AMD, Qualcomm, every major TSMC customer is now paying what I call a geopolitical risk premium. They are accepting higher costs and longer lead times for non-Taiwan production as insurance. NVIDIA in particular has been vocal about wanting fab diversification. Jensen Huang has been pushing for advanced packaging capabilities in the US specifically because NVIDIA's Blackwell and Rubin AI chips are the most packaging-intensive products TSMC makes.
And there is a financial dimension that investors are not fully pricing in. TSMC's $56 billion capex for 2026 is largely driven by this diversification imperative. Building identical capabilities in 3 geographies, Taiwan, Arizona, and Japan, is inherently more expensive than concentrating in one location. The cost per wafer in Arizona is estimated to be 30 to 50% higher than in Taiwan due to labor costs, permitting complexity, and the learning curve.
That cost differential is crucial. If geopolitical risk subsides, TSMC has overbuilt expensive overseas capacity. If risk escalates, the overseas capacity is insufficient because it is still 2 generations behind Taiwan. It is a Goldilocks problem with no perfect answer, and TSMC's management knows this. CEO C.C. Wei explicitly dismissed bubble concerns at the January earnings call, but admitted the company, quote, must invest carefully, end quote. That is corporate speak for, we are spending more than we are comfortable with, but we have no choice.
And let's not forget Europe. TSMC is building a fab in Dresden, Germany, focused on automotive chips. It is a smaller operation, but it signals that the diversification is truly global. TSMC is evolving from a Taiwan-centric foundry into what some analysts are calling global TSMC. The Taipei Times ran an editorial in March 2025 titled Silicon Shield to Global TSMC, arguing this transformation is irreversible.
And DigiTimes reported in January 2026 that TSMC's overseas expansion is clearly centered on Arizona, while Japan and Germany expansions have somewhat stalled in comparison. The implication is that U.S. political pressure is the primary driver of diversification, not pure business logic. TSMC is expanding where Washington tells it to expand, and that asymmetry says everything about the power dynamics at play.
Which raises another question. What about TSMC's profitability through all of this? Because spending $56 billion on capex while building in expensive locations like Arizona has to squeeze margins eventually.
TSMC's AI accelerator revenue is growing at a 50% compound annual growth rate through 2029. That extraordinary demand gives them pricing power to absorb higher costs, for now. But the question is, what happens when the AI capex cycle eventually normalizes? If revenue growth slows from 30% to 10% while diversification costs remain elevated, you could see a significant margin squeeze. That is the medium-term risk that the market is not fully pricing in.
And let's not forget Europe. TSMC is building a fab in Dresden, Germany, focused on automotive chips. It is a smaller operation, but it signals that the diversification is truly global. TSMC is evolving from a Taiwan-centric foundry into what some analysts are calling global TSMC. The Taipei Times ran an editorial in March 2025 titled Silicon Shield to Global TSMC, arguing this transformation is irreversible.
And DigiTimes reported in January 2026 that TSMC's overseas expansion is clearly centered on Arizona, while Japan and Germany expansions have somewhat stalled in comparison. The implication is that U.S. political pressure is the primary driver of diversification, not pure business logic. TSMC is expanding where Washington tells it to expand, and that asymmetry says everything about the power dynamics at play.
Which raises another question. What about TSMC's profitability through all of this? Because spending $56 billion on capex while building in expensive locations like Arizona has to squeeze margins eventually.
TSMC's AI accelerator revenue is growing at a 50% compound annual growth rate through 2029. That extraordinary demand gives them pricing power to absorb higher costs, for now. But the question is, what happens when the AI capex cycle eventually normalizes? If revenue growth slows from 30% to 10% while diversification costs remain elevated, you could see a significant margin squeeze. That is the medium-term risk that the market is not fully pricing in.
All right, Maya, contrarian corner time. And this one might be my most controversial take yet. Here it is. The real risk to the global semiconductor supply chain is not a Chinese invasion of Taiwan. It is TSMC's own diversification strategy hollowing out Taiwan's competitive advantage from within.
Okay, that is a genuinely provocative thesis. Walk me through it.
The consensus view is that Taiwan faces an external threat, Chinese military aggression, and that TSMC's diversification is the rational response, spreading production globally to reduce concentration risk. My contrarian view is that the diversification itself creates a different kind of risk. Every fab TSMC builds outside Taiwan weakens Taiwan's bargaining position. If Arizona can produce 3-nanometer chips and Japan can do the same, then Taiwan's silicon shield loses deterrence value. And once the shield weakens, the very threat it was designed to prevent becomes more likely, not less.
Wait, so you are arguing that diversification makes Taiwan less safe? That is counterintuitive.
Think about it from Beijing's perspective. If Taiwan produces 92% of advanced chips and there is no alternative, any military action risks destroying the world's chip supply, including China's own. That is a powerful deterrent. But if TSMC has significant capacity in Arizona, Japan, and Germany, then disrupting Taiwan's fabs becomes less catastrophic for the global economy. The cost-benefit calculation for Beijing changes. The N-2 rule helps because Taiwan maintains a technology lead, but technology gaps close over time, especially when you are spending $165 billion to close them.
That is a really uncomfortable argument. You're essentially saying Taiwan's greatest asset, TSMC, is being forced to undermine Taiwan's greatest defense mechanism.
And there's a deeper irony. Who is forcing this diversification? The United States. Washington pushed hard for TSMC to build in Arizona, using the CHIPS Act subsidies as both carrot and stick. The U.S. government's logic is straightforward. We cannot be dependent on Taiwan for critical chips. But the unintended consequence of reducing U.S. dependence on Taiwan is also reducing China's cost of disrupting Taiwan. the U.S. is inadvertently weakening the very shield it relies on.
But counterpoint, does Taiwan have a choice? If it refuses to diversify, it risks losing U.S. political support, which is the other pillar of its defense. Taiwan needs American weapons, American diplomatic backing, and American security guarantees. Saying no to Washington on TSMC Arizona is not really an option.
You are absolutely right, and that is what makes this a genuine dilemma with no clean solution. Taiwan is caught between two imperatives: maintain the silicon shield by keeping production concentrated, or maintain the American alliance by enabling diversification. It cannot fully do both. The N-2 rule is Taiwan's attempt to thread this needle, giving the U.S. enough to satisfy security concerns while retaining enough to keep the shield relevant. But it is a balancing act that gets harder every year.
Let me add another dimension. Most analysts assess that a full-scale amphibious invasion of Taiwan is unlikely before 2027 to 2030 at the earliest, due to PLA logistics and training gaps. The more probable near-term threats are gray zone actions: naval quarantine, cyber attacks, undersea cable disruption, information warfare. How does the silicon shield hold up against those?
Poorly. A naval quarantine would not destroy the fabs, but it would cut off the supply of critical chemicals, photoresists, and EUV pellicles that TSMC needs to operate. Many of these materials come from Japan and Europe. If China blockades Taiwan's ports for even 2 weeks, TSMC's production lines start running out of consumables. The fabs survive intact but cannot produce. It's a way to weaponize Taiwan's chip production without firing a shot.
And that is the scenario that keeps supply chain executives up at night. Not an invasion, but a quarantine that paralyzes production gradually.
Exactly. And here's the data point that should concern everyone. An Arsenal report analysis from March 12, 2026, estimated that a Taiwan Strait disruption would simultaneously hit chips, defense production, and consumer tech. The ripple effects across automotive, AI, mobile, and defense would cascade within weeks, not months. The global economy has built a $1 trillion AI ecosystem on a single point of failure.
So your contrarian view boils down to the more TSMC diversifies, the weaker the deterrent, and the more fragile the entire system becomes during the transition period before overseas fabs reach parity.
Precisely. We are in a window of maximum vulnerability. Taiwan is still producing the most advanced chips, but the narrative is shifting toward we can replace Taiwan eventually. That narrative change is itself a risk factor because it alters Beijing's strategic calculations. The silicon shield is not gone, but it is thinner than it has ever been. And the people thinning it are, ironically, Taiwan's closest allies.
All right, Maya, let's close out with 3 action items for our listeners.
Action item number 1.
Number 1, treat TSMC's geographic diversification as a multi-year investment theme, not a one-time event. TSMC is spending $52 to $56 billion in capex in 2026, and market estimates suggest over $50 billion annually through 2028. This is the largest industrial relocation in semiconductor history. For investors, the direct beneficiaries are clear. Equipment makers like Applied Materials, Lam Research, and Tokyo Electron are guaranteed revenue streams as TSMC builds out Arizona, Japan, and Germany simultaneously. The construction ecosystem around Phoenix, Arizona specifically, is experiencing a historic boom. Real estate, skilled labor, utilities infrastructure, all of these are secondary plays on the TSMC Arizona buildout. But here's the nuance. TSMC itself may see margin compression as overseas costs are 30 to 50% higher than Taiwan. Watch the gross margin trend in Q2 and Q3 of 2026. If it dips below 60%, that is a signal that diversification costs are becoming material.
That is very specific. A gross margin below 60% as a warning signal. I like that framework. What about number 2?
Number 2, price in a Taiwan risk premium to your portfolio even if you believe invasion is unlikely. Most institutional investors are underpricing Taiwan risk because they put it in the black swan category, low probability, impossible to hedge. But gray zone scenarios, quarantine, cable cuts, cyber attacks, are much higher probability and would still cause massive supply chain disruption. A practical approach is to assess your portfolio's direct and indirect TSMC exposure. If you own NVIDIA, Apple, AMD, Qualcomm, Broadcom, or any major tech company, you have significant TSMC dependency. Consider whether your position size reflects the tail risk of a 2-week production halt in Taiwan, which would crash the entire AI supply chain. Insurance is cheap when nobody thinks they need it. Companies like Global Foundries, Samsung Foundry, and Intel Foundry Services represent imperfect hedges, but could see massive valuation spikes in any Taiwan disruption scenario.
Having even a small allocation to these names is portfolio insurance worth considering.
Portfolio insurance for semiconductor risk. That is a great way to think about it. And action item 3?
Number 3, watch the N-2 rule as the most important geopolitical indicator in semiconductors. The N-2 rule, which restricts TSMC's overseas fabs to technologies at least 2 generations behind Taiwan, is Taiwan's single most important strategic policy. If that rule is relaxed, either under U.S. pressure or voluntarily, it signals that Taiwan has decided the American alliance is worth more than the Silicon Shield. That would be an inflection point with massive implications. It would mean TSMC's Arizona fabs could access leading-edge nodes much faster, which is great for U.S. supply chain resilience, but weakens Taiwan's deterrence. Conversely, if Taiwan tightens the rule or adds new restrictions, it signals growing confidence in the shield's deterrence value. Any change in this policy should be treated as a Tier 1 geopolitical signal, equivalent to a central bank rate decision in its importance for markets.
That is a fascinating indicator. I had not thought of the N-2 rule as a geopolitical barometer. It is essentially Taiwan's way of signaling how secure or insecure it feels about its strategic position.
Exactly. And here's the takeaway I want everyone to remember. The semiconductor industry has crossed $1 trillion in annual revenue for the first time in history. TSMC alone accounts for 72% of the global foundry market. This level of concentration in a single company, on a single island, facing a single geopolitical adversary is unprecedented in any industry. We are betting the entire AI revolution, the entire mobile ecosystem, the entire autonomous driving future, and significant defense capabilities on the assumption that the Taiwan Strait remains peaceful. That is a bet worth understanding, monitoring, and hedging against, even if you believe, as I do, that the most likely outcome is continued stability. The cost of being wrong is $10.6 trillion.
$10.6 trillion. That really puts it in perspective. And coming up next, we are going to look at ASML's China dilemma. The world's only maker of extreme ultraviolet lithography machines is caught between U.S. export controls and its biggest growth market. The numbers and politics are fascinating. You will not want to miss it. And I want to add a final thought on the human dimension of this story. TSMC employs over 70,000 people, most of them in Taiwan. These are some of the most specialized semiconductor engineers on the planet. There is a Truman National Security Project paper called Saving Taiwan Silicon Scientists that argues the real strategic asset is not the factories, it is the people. Fabs can be bombed or blockaded, but the knowledge in those engineers' heads is the true silicon shield. Whoever controls that talent controls the future of chip making.
That is a critical point. The fabs are the hardware, the people are the software, and software is much harder to replicate or destroy. That is actually the strongest argument for why the silicon shield may endure, even as fabs are built elsewhere. You can build a factory in Arizona, but you cannot replicate 40 years of Taiwanese semiconductor culture and expertise overnight.
Thanks everyone for listening.
Stay data-driven. Bye.